Hello guys, welcome back to my channel. In this video, we'll do a quick stock analysis of one of the companies that was recently bought by Li Lu, one of the best investors in the world. That company is none other than West Bancorp, a US bank that I certainly believe is hugely undervalued. Bear with me until the end of the video to see whether it's worth incorporating that stock, that company, into your investment portfolio. Let's get started. West Bancorp is the parent organization of West Bank. This bank was founded in 1973 in LA to serve the Chinese American community in Southern California. Apart from being one heck of a bank financially, which we'll talk about later, it's worth mentioning that it has been recognized as one of America's best banks since 2010, and also in 2018 was ranked number 5 of America's 100 biggest banks. So it's not a company that can be described as a low quality company. It's a high quality bank. And the reason we are talking about this bank today is because Li Lu, one of the best investors in the world, who's managing over $20 billion in total, I believe is the number, has been buying shares of West Bancorp recently in the last quarter. Although we are only seeing here the stocks he bought and he, owns in the US, his capital is far larger than this. So now we're going to be doing a quick valuation to see why Li Lu has been buying shares of this company. This is a spreadsheet I got from Investing with Tom, so shout out to him. And we're going to be having a look into the financials of the company. We'll get all the data and see what return we're going to get from that stock. Shall we buy it at this current price? Let us start by the normalized return on assets. We can get this number here, and we see that the 10-year average is 1.3. Although it's worth mentioning that in the recent years, in the last years, the company's grown that number. 1.4, 1.8, 1.6, 1.2, 1.5, 1.8. I would say it's higher, but just to be conservative, let's just stay with this number, with 1.3. Let's plug in this 1.3 here. Second up, we have the normalized assets to equity. We also can get this number from here. And if you go here, assets to equity, which is a ratio, it's the number of assets divided over the total equity of the company. You'll see that the average is around 10. So let's stick to that number just to make things easier. 10. Then the payout ratio, we can find it here if we go to the income statement of the company, and we'll see that the payout ratio is roughly 20%. So this last year was 20.2%. And some years been a bit higher, some years has been a bit lower. So let's stay with 20% to make this thing easy for us. Now the current price to book ratio. This we also can get from here. We are currently at 1.18. That's the ratio. So let's plug into that number, which means it's quite cheap, by the way. And let's now find out what is a good multiple. What is the multiple that we're going to be, or we expect the company to be trading at in the future? So if we look at the lines here, we'll see that a pretty, rough estimation would be somewhere around 1.8, 1.9. We actually do have the average here, the mean. It's 1.81 in the last 10 years. So let's plug into that number. But it's going to be higher than that, but let's be conservative. 1.81, and this is the years that we want our investment to go through. So we expect this future price to book ratio to go up in the next 5 years and to get to this average number. It could go higher if these we'll see later, but let's now analyze the data. We do have here that based on our assumptions, which are quite conservative, and the numbers we've got from the balance sheet and the income statement, that we could expect an easy 20% return, annual return over the next 5 years, shall we buy into this company right now at current prices? And as I said before, if we go back and take a higher price to book ratio, let's say somewhere between, I don't know, 2.2, for example, the higher end of the spectrum, what's going to happen here? It's going to happen that we could expect a 26% annual return. And don't forget that 26% annual return means that you are doubling your money every 3 years, which is insane. Well, guys, that was the stock analysis of West Bancorp and what we can expect in terms of returns shall we invest into the company. I must say that I did invest in the company some weeks ago and I paid $46 per share. The price been going up slightly since, but it's not anything crazy. It's been up just 10% or something. Bear in mind that we're talking about a company, a stock, that's probably undervalued somewhere between 60 and 75%, which means there's a lot of room for it to go up. So don't worry about these small price fluctuations. If you like this sort of content, just let me know and I'll try to do more stock analysis for you guys. Just make sure to like and comment the video and don't forget to subscribe. Thank you for joining. See you on the next one.